Hello, YouTube, and welcome back to a weekend video. This weekend, we're going to talk about one simple pattern which might tell us that there is a bear trap being set. We reviewed this about 4 months ago when we were talking about a test of the 50 monthly moving average and then a bounce. So we were set for a continuation higher until we got the SVB banking crisis. But if we get an update on this chart, let's try to be a little bit objective this weekend because as long as we keep forming higher highs, which is what the seasonality chart tells us, April's supposed to be the best month of the year. And right now, we are only up by about 0.75% on the month. But let's be a little bit objective here, like I just mentioned, and look at the pattern. So we hit the 50, and then as we go higher, we hit a little bit of indigestion. But then after that, we just what? Keep forming higher highs, higher high, higher high, higher high, higher high, higher high, higher high. And the expansion continues. So what I'll be paying particular attention to is that first of all, we stop going down, which is a very positive sign if it holds for the second half of the month. We have bullish volume coming in. And what do we have? Well, we got, other than the SVB crisis, we are now resuming the higher highs. So it is very important we remain above 410, which is going to be our March high. And as long as that continues, if we stop going down on our monthly time frame, do you remember what happened when we stopped going down on our daily time frame and our weekly? Well, we went higher. So there is the break. We stop going down, we get a back test, and then we go higher. And what's so interesting about this is just that when we look here a little bit closer, we have a look at our seasonality pattern. We go up until we don't. So as long as we form those higher highs every month, eventually we're going to crack, but it should be a higher low as well. So that's what I'm watching for. There's the crack, there's the back test, and then we advance. But what do we have? Low, higher, low, higher, low, higher, low. So I know people might think that the seasonality chart is not applicable this year, but remember, this includes the last 20 years, including 2021 and 2020, which means this is the last 20 years ending ending 2022. Sorry. And this is important because I'm also noticing a lot of the psychology at play here. I'm hearing a lot of, I told you so. What did I say? Luckily, I sold everything at the bottom. And now it's just starting to say, people are, again, the bears are just starting to say, what's going on here? Man, I thought we were going to go lower. This is getting painful. Will you please just let me out? And before we go further, I'm going to ask you for a huge favor, please, and thank you. If you could, please consider smashing that thumbs up and subscribing to the channel. I will greatly appreciate that, and I will thank you ahead of time. All right, so when we look forward here to an update on the ES levels as well, because, oh my goodness, these shorts will just not relent. We note that 4150 is now the new last notable pocket after the update that I gave on March 29th. And why does this matter? Well, because we closed over that area at 4163 as of Friday. And when we look here to the short report, man, these shorts are like, I don't know, like this is getting painful for them. So they were at 320 last week. Now they're at 307. And this is a short level we have not seen since 2020, 2007, or 2011. So they are increasingly short. It is getting increasingly painful. And if you remember last week, we talked about earnings beats. So let's go through that really fast, and then we'll circle back and talk about some more charts in a few moments. So here is the earnings calendar for this next week. So no surprise, there's more things to worry about. As we're going to note here, again, we have a wall of worry. So there's a slope of hope, and then we have the wall of worry. And sure enough, we got a lot of people who were worried. So I asked this about 11 days ago, and thank you to everyone who answers our community polls. I said, do you trust this rally? And 7 out of 10 people said no. So what would I call that? I would call that a wall of worry. Why? Because we keep going higher, but no one wants to believe it. 7 out of 10, 8 out of 10 people are just like, man, I just don't believe it. It's not real. But they continue to not participate in the move higher. So if we remember that last week, a lot of companies were expecting beats. What are we expecting from Netflix, Tesla, TSM, and a few other large companies? Because there's some regional banks this week. There's we have a credit card company. We got small banks. Let's see what it says here. Tesla expected to beat. All right, cool. Charles Schwab expected to be in line. Okay. Bank of America expected to beat. Netflix expected to beat. Johnson & Johnson expected to beat. Goldman Sachs expected to miss. Sorry, Goldman Sachs. All right. MNC is expected to beat. All right. What do we got next here? State Street is expected to beat. Lockheed Martin is expected to beat. If you're not noticing a pattern by now, hopefully you do. TSM, or Taiwan Semiconductor Manufacturing, expected to beat. So the theme to me is very, very clear. There's also a couple things we want to be mindful of going into earnings season. Again, that wall of worry, because we're expecting an ugly earnings season according to Bloomberg. But as I just showed you, last week was pretty surprising. It was upbeat. And as of right now, we're also expecting an upbeat week. Impact of banking stress will be key as companies report. So 100% this will be in focus. Their forward guidance will be very important. But what are they telling us are the things to be mindful of? We're looking for the weakest quarter in 2023. Analysts expect earnings to bottom in the first quarter, the worst since 2020. One more time, earnings are going to bottom in the first quarter. What does that imply? Well, it implies that we're going to see higher growth from here. And that is very important because, man, Q1 wasn't all that bad. We note that we had 2.4% GDP growth. So that's a very good signal for these banks. We also note that we have the banking crisis a little bit less worrisome than it was before, because for the fourth consecutive week, we know that the Fed's balance sheet has been reduced. Down, down, down. Okay, interesting. So let's go through here. And this also assumes they're right. So there's the news, there's a reaction to the news. They could also be wrong. But if we take what they say at face value, this should be the weakest quarter. And we're expecting beats. So, like, are we going to get a landing? Is there going to be no landing? I'm not smart enough to know that, but I'm sure people who are watching are. So please make sure to smash that thumbs up as you're dropping me a comment and subscribing to the channel to tell me what you think is going to happen this week. Please and thank you. All right, let's go further down here. Banking stress. So I just showed you that Fed balance sheet where, hey, looks like it's not so bad. We'll have to hear this week, but I would assume, again, keyword being assumed, that if banks needed more money, they would have tapped this market here because the Fed said, hey, we got unlimited supply if you want to come in and borrow from us. All right, so moving forward, sales versus margins. We're just going to skip that for now. Again, that's basically earnings. So we'll just skip that for now just because it's a little bit complicated. Corporate spending, I'm expecting that to come down. And who would get hurt from this? Likely technology companies. So we'll hear more about that next week and the week after. Also, a lot of cost cutting from companies like McDonald's, Walt Disney, Walmart. They've all slashed their payroll. So what does that mean? Job cut mentions hit 2020 peak in first quarter. We also note that we have a lot of mentions here, right? So this is what the Fed wants. The Fed wants to see people lose their jobs. I know that's not nice to say. I know it's not what we want to hear, but that is how the economy can cool even more. We talked about sticky inflation before. Now, the easy come, easy go inflation. Now we have to get through that sticky inflation, which might stick around for a little bit longer. Looking forward to the economic calendar for next week. There's not a huge amount of data on the docket, so I'll be paying particular attention to big tech, notably Tesla and Netflix, also TSM and a few other companies we just mentioned. China's going to be reporting GDP on Monday night, expected to come in at 4, which is going to be greater than their previous reading at 2.9. That is a good indication for global growth. We also have their industrial production coming in with a higher reading than their previous number, which looks constructive. We have core CPI coming out of Canada, but no forecast as of right now. CPI coming out of Great Britain and the European Union, which is expected to come in either down or in line. There we go. Initial jobless claims going to tick up by an extra 1,000. And we note that PMI is coming in a little bit less negative. So again, bad data is good, but terrible data is not good. And as we look forward to retail sales out of the UK, we're expecting to see a negative contraction or negative 0.5%. So not a lot of data this week for America, but those earnings are going to be in focus. So if now we understand that, like, how the hell can we be poking over this monthly downtrend? Well, people said the exact same thing on this daily downtrend here. Poke, rejected, poke above, claim it, backtest, and then advance. Might not be an easy journey. We showed you that on the seasonality chart. It might not be a straight line higher. Maybe we get a push-pull, eventually claim it. Maybe we hit it and get a rejection. Or maybe we just launch higher. I'm not sure. I'd love to tell you exactly where we're going to go. I just don't have 100% confidence. So here's what I'm watching for. When we note the monthly pattern here, here's what I expect. What I expect versus what's going to happen are two different things. So please take what I say with a grain of salt. I'm just some guy on YouTube. I'm not a financial planner. I'm not Jesus Christ, and I didn't write the Bible. Here we go. So we have this big leg down, and we note that we price discover all the way back up to the previous period, which leads to 2 red months. We get a little bit of consolidation and then advance higher. So we did not do that on the most recent period, but I'll tell you what I'm looking for. It is very simple. I mentioned it at the onset. Higher monthly highs, higher, 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 higher. we consolidate, and after the consolidation, we form higher lows. So we form offense, or we expand into the test, we back test with higher lows, and then we put up another big advance with just continuous higher highs. Every single month, we go higher and higher and higher. So if now we fast forward to where we are now, let's see if we can apply that exact same thinking, because April's supposed to be the best month of the year. We've already had a terrific January. We recaptured a lot of losses into March. But if we note that we look here to March, if again, keyword there being if, we held the real body and we didn't get the SVB, what would we have formed? We would have formed higher lows. So we formed the higher lows on the contraction again, and I'm deleting the SVB because that, I believe, was an anomaly. So we're going to ignore that for now. If you would disagree, please drop me a comment and tell me the reason why. So we got a higher high. So what's very important for me is that we birth the bull by getting above our February high at 418.31, which is about 1.5% higher from where we are right now. So if we can't rally 1.5%, that might be it. So 1.5% is not that much. When we look here to our weekly chart, we note that we've already gone up by 20%. And to birth the bull, we just have to make it to 417.8. So if we can't rally up 1.5% into the strongest seasonal month of the year, when we have bullish volume, we have continuation, we have higher highs, higher lows, I don't know what's going to happen. So now you know my base case. Let's look at a few more quick charts to see exactly what else is being signaled out there. We're going to go to weekly charts now, and we're going to note that we noted that we were trying to stop going down, which is this weekly downtrend, but we were kind of failing to go up. So we note that we have two green lines now. The first green line is going to be easier to hold or less acute. It's a shallow uptrend. And here we have an acute uptrend, which just means that it's a higher degree. It's harder to hold, but that's the one we're currently rocking. So if we note that we're still maintaining it, look at the blue line I have noted right here. Why is that important? Because for me, the signals whether or not we're actually not just forming a defense, which are these uptrends here, but are we actually doing offense where we're actually recapturing all-time highs? So if you look to 2018 to 2020, we connect the dots or the lines, right? The candles. We note that we have a clear area here for us to reclaim. All we got to do is rally up by 1.5% to 418. We're above all the averages on the daily, on the weekly, on the monthly. Price action's bullish. We got a massive short. We got bullish volume. This should lead to continuation. And as we noted on the seasonality chart, I believe the QQQ is already leading us. So we note that we did actually form a lower low, but we did hold it, which means we have a lower low and a lower high. So I think it's going to be very important what happens to Netflix and Tesla specifically this week to see whether or not we can actually crack and break this relative high at about 321. Why? Because we're closing at the high of the week. We're already in bull market territory by being above 30512, but we have not yet recaptured 20% off the low or getting above 32697. That for me is a very important area. Another way to think about it is that the turning point we talked about is almost at the target of the red line. And the red line corresponds with an area that S&P is at right now, or a 50% retracement. So that 50% just means that we've now recouped half of our losses from the all-time high to our October low, and then we bounced. So look at the numbers here, 38 to 50. Let's look back at SPY now. So here we got the 38. Yeah, there was a push-pull off of it, right? Hit it, backed off. Now we got finally back over it. And what's so important about here is just that if we hold this 50%, I think we can squeeze to 430. As I just noted on the monthly chart, that would be my target. However, if we do not hold the monthly higher low, that is where it could be time for us to tank. I don't care what the news is. If we form a monthly lower low, I believe that we are going to be going lower. So I think that this is going to be, it's like center field. So if you like football, we got the red team and we got the green team. We're at the 50-yard line. Who wants it more? I think it's the Bulls, because I think that these Bears are so bitter, they're so upset, and they just cannot believe what is happening here. Let's look at two more things which are very telling here. Actually, a couple more quick charts. We look at DXY. Man, it's like going straight down. Is that maybe why the S&P is going straight up? It could be. 0.5% down here on the dollar is definitely giving a lift to equities, which means stocks in the NASDAQ. We stopped going up. We're below the 50 MA. We have a head and shoulders. It looks constructive. It looks like maybe we're going to keep going down. We look to the VIX next, which is now at 17, which means that The market's like, man, I don't need insurance. Screw it. Time to buy. There's FOMO. That's what I am noticing. VIX is hitting a fresh 1706. Here we hit 1707. Oh my goodness. Double bottom on 2023 lows. The last time we hit this area was at the end of January. And again, that was our massive rally. All right, just one more chart here for us to look at. We know Bitcoin crossed 30K, impressive week. Ether had a Shanghai upgrade up 12.89%. It is flexing. We're going to look at RSP because the easiest way to think about the market beyond just tech, we looked at the heat map earlier this week. Now we're going to look at RSP because what happened? Oh my goodness. We got our third weekly candle close over our 50. We got bullish volume that's been forming since the October low, and we got a higher high and a higher low. This looks pretty good. So with that said, I thank you so much for watching. I wish you the best of luck this week. Please be mindful of the risk. And if you haven't already, I would encourage you to watch last weekend's video where we walk you through everything we thought that would happen going into this week. If not, I wish you the best of luck, and I thank you again for watching.